So if you're a syndicator now, in 3 to 5 years, you will be doing your syndication as a tokenized offering. It's just a better accounting system at its core than what you're doing now. And if you can also provide your investors liquidity, that just makes it so much easier to bring in investors. So if someone else is doing a similar offering and they're offering this to investors and you're not, they're going to choose the other offering.
Hello, Ginny Bolling here with Pivotal REI, the real estate investing podcast. And today I have Steve Streetman with us. Steve, thank you for coming on. I appreciate it.
Well, thank you for having me, Jenny. I'm really honored to be on your podcast.
Well, thank you. And I am glad that you're in Florida now because I know a lot of people that are curious about the things that you do. And I want to be able to stay in touch, and just being in the state makes it automatically a little bit easier, I think. And so, welcome to Florida.
Well, thank you.
Yeah. So you have interesting background because of, and the reason I say that is you've intertwined real estate with the digitalization world, and it's really coming on fast and heavy, and it's so confusing for so many of us. So please go ahead and tell us how you got into it and what it means to you.
Well, I'll start earlier on. I kind of got my out of the box approach even in college. I created my own major of music modified with mathematics, combining those two things together. And as far as I know, I'm the only person ever to graduate from Dartmouth with that major. um, I started my career breaking codes and ciphers for a three-letter agency we won't name. And I got into the intelligence community where I built a whole career as a data scientist, doing terrorism risk assessment and systems integration and sensor integration. But I got interested in real estate after I read Robert Kiyosaki's Rich Dad, Poor Dad way back in 2004. And I started just banging myself on the head saying, what am I doing trading hours for money? I should be building assets. And I started investing in real estate back then. Early on, realized I would prefer commercial to residential, just a temperament thing, I think. And then I guess around 2011, I got involved with a community called the National Council of Exchangers. And these are guys who trade real estate. It's like, I'll give you my free and clear house and a $300,000 note for your fourplex. It's very, very creative deal making, which was a lot of fun. And this kind of brings me up into 2017 when I was offered cryptocurrency for land. And my first thought was, well, what's cryptocurrency? And I'd heard of Bitcoin, but I didn't know about the whole thing that was emerging that time. And 2017 was the year of initial coin offerings for all kinds of cryptocurrencies. There was a huge ecosystem that was being built around crypto. And so I ended up doing the deal. I had to make it a three-way exchange. I had to create a closing process because the title company had no idea how to handle cryptocurrency in a closing. So I created a title process, got the title company to sign off on it, and we did the deal. And I got really, really interested in all things cryptocurrency and real estate and ended up publishing a book on that subject, cryptocurrency and real estate, in 2021. So got involved in all kinds of things after that because there was opportunities to speak about cryptocurrency and real estate in a lot of different venues. I got into community development, doing like building homes with 3D printers and hemp and trying to pull all kinds of modern technologies together as part of the Free Cities movement and all these sorts of things. But I really have been fascinated by this intersection of real estate and cryptocurrency. And so when I was developing these ideas for a community, one of the things that I really, really wanted to do was to make sure that anybody who worked in the community could afford to live there. That was very important to me. I thought, how do you even do that? Because you don't want to be controlling the prices or anything else like that. And I came up with a way using real estate tokenization to do affordable housing through fractional ownership. And I won't go into all the details of that, but that got me really, really interested in the tokenization side. And so I've been an advisor to a couple of different real estate tokenization companies over the past few years. And then finally last year, I looked and I've been very disappointed at how real estate tokenization has progressed. It's just not gotten where I thought it would be, as I suggested in my book, because it's just better than syndications, and we can talk about that, but it needs something to really be viable. And as I've gone through and analyzed and figured it out, there are some things that are missing in most of the tokenization approaches. And so a partner of mine and I, Diane Davis, formed a company called Grotto, and we're going to finally do it right. We're going to try to pull all together all the pieces that you need to actually make a usable real estate tokenization, call it ecosystem, where we're not going to create every little piece, but we're going to find all the pieces that are out there that are good, put them together, and any piece that we need that's missing, then we'll create that part. So that's sort of the mission of our company, and come down here to Florida to really be cranking on launching that company and getting it going full time. And that sort of brings us up to the present day. Real estate, cryptocurrency, data science, it's all one thing.
Well, so yeah, since you wrote the book, that was right as interest rates were going up and they've stayed up, and so we're in the stress period right now. So it's understandable that things aren't necessarily going as fast as what you may have wanted. But so, and as you know, I want you to say what you want the listener to take away from this discussion. So does that tie into what we're talking about? Can you share with us what that is?
Well, one of the things I'll say is that if you're a syndicator today, in 3 to 5 years, you will be tokenizing. And it's just a better approach to syndication. It's exactly like a syndication. You still do your PPM documents, right? You still create your entities. You're still doing fractional ownership. You still have to obey all of the SEC rules. It's just if you do a distribution now as a sponsor, you put up the total for your distribution, and the smart contracts that underlie the tokens automatically distribute it to all your investors. It's done. It doesn't make a mistake. There's no human error. There's no multiple wires that have to go out. You can make that happen very quickly and easily. Tokenization automatically enforces not just the SEC rules, but it can enforce the global rules. So that if you have investors from outside the US, it can enforce the rules where they live for them while it's also enforcing the SEC rules. So compliance becomes automated. Tax documents can become automated. There's a whole bunch of things that you get by moving to a tokenization that you don't get with a syndication. And that's what's happening right now in not for real estate specifically, but for US Treasuries, which are already liquid. People like BlackRock are now tokenizing their US Treasuries funds because it's just faster and cheaper and more efficient for them to operate the fund as a tokenized fund than as a regular fund. It's just the efficiency. But the other reason why real estate syndicators are going to move to this is liquidity. So real estate's not liquid.
Yeah.
So if I'm investing in an apartment complex and the sponsor for the deal is offering me, hey, I'm going to take your money, your $250,000, and I'm going to keep it for 3 or 5 or 7 or 10 years. And you don't know exactly how long I'm going to keep it because it's going to depend on how well the property performs. You're not going to get your capital back until the end. You'll get it back if it's a good syndicator. You will get your money back, but you don't get it back until you refinance or sell. And you just don't know exactly when that's going to be. It might be 3 years. It might be 5 years. It could be longer. Now, suppose I have a tokenizer, has exactly the same apartment complex, exactly the same returns, and they come to me and they say, yes, I'm going to take your 250,000. I'm going to give you the same returns on the same apartment complex. Oh, but after a 1 year lockup period, if you need your money back, you can sell your interest on a secondary marketplace. And if you don't want to sell your interest, but you really need to get access to your capital, you can get a loan secured by your interest, by your equity, by your tokens. And now you can use that loan to invest in that new hot opportunity that you've got while keeping invested in this. So of those two, which one are you going to pick?
Yeah, the
I mean, it's a
tokenized.
no-brainer.
Yeah. Yeah, yeah.
Um, so I think that's why in 3 to 5 years, most syndicators are going to be transitioning to doing their syndication as a tokenized offering. And so these aren't Bitcoin, just to be really clear, right? Right? People think of cryptocurrency, they think of tokens, they think of Bitcoin, they think of price volatility, they think of speculation. Some people think Ponzi scheme. These are tokens that they're all they are is a representation of an ownership of real assets. This token says if I have an apartment complex and I issue 100 tokens, I have one token that says I own 1% of this apartment complex. That's all that token means. And so it becomes much more clear, and the value of the token should always be the value of the apartment complex.
And
And
the
so
token is digital. That's why it's
the
called
token is
digital
digital.
assets.
Yes, and it's digital assets, and it's easier to move, it's easier to trade, it's easier to buy and sell. Because to do the buy and sell, all you have to do is manipulate bits on electrons. But then that buy and sell is recorded on a public blockchain, and nobody can go in and change that. You can prove that you own this, as opposed to most syndications. Most syndicators will give you a paper certificate saying you have something, or your subscription agreement is it, or maybe they'll put a line in their spreadsheet, and that's what your ownership is. In this case, you get something a little more publicly provable, a little more solid, that proves that you own what you own. So that's another thing that I think will be comforting to investors going forward. So it isn't so much that tokenization is a completely new thing. It's more that it is enhanced accounting for a syndication.
So let's go deeper on that.
Okay,
It's more solid than a share certificate,
right. A share certificate is just a piece of paper,
right?
right?
And this
Um,
is because it's on the blockchain.
it is because it's on the blockchain. Because when you send that token to a place, a wallet, they call it a wallet that you own, you can go anywhere. Anybody can prove that your tokens are in that wallet. Your name's not on it, right? But they can prove that those tokens are in your wallet. Anybody can check and see that that's true. So you can prove that to any third party without any issues at all.
And that's because your wallet is going to have it like an IP address.
Yeah, well, the wallet has a really long alphanumeric number, right? It's like 20 or 30 digits long. And without getting too technical, it's technically a public key.
Yeah.
And
Okay.
then you have the private key. And the only way that things can move is if your private key gets combined with a public key to sign a message saying, I want to move it. That can be complicated and intimidating for investors, right? They might not want cryptocurrencies, but there's a solution to that, and it's called a custodian. So, in the same way that your stockbroker actually holds your stocks in your account, a custodian would hold your security tokens or your ownership in the real apartment complex in an account, and the custodian is responsible for doing everything for crypto. So if you're a real estate investor and you don't even want to touch crypto, you can still be involved in a tokenized asset. Your custodian will just send you the distributions to your bank, and you never touch cryptocurrencies. So it still works for old school people. And it works great for new and upcoming investors who are digitally oriented because they can self-custody if they want, or they can use a custodian. And then if they have a custodian, they can essentially lock their tokens, what they call a vault, and get a loan secured by them. So they can get access to their capital. Whether that's advisable, it probably isn't advisable for all investments. But if you have an investment with really solid regular cash flow, and you can get a loan at where the loan payment's less than your cash flow, that's actually not a bad thing to be able to do. And now you can take those proceeds and put them into another investment that you see the next really hot thing that's out there. So you can get
Yep.
invested in more apartment complexes.
It's using the same dollar in two places or more. Yep.
Exactly.
Yep. I love it.
Well, the other thing that's really, I think, important about this is that right now, private offerings are almost always limited to accredited investors. I mean, it used to be you could have some, or it is still is true that you can have some sophisticated investors, but if you actually elect to do that as a sponsor, you can't advertise. And advertising is big. So almost everybody does a 506c offering. They limit it to accredited investors. After a 1 year lockup period, when you get into this secondary market, you're no longer limited to accredited investors. So if an average investor, somebody who doesn't have $100,000, wants to get invested in that really incredible apartment complex or a beautiful resort or a great office building, maybe not office buildings these days, but we'll see. Um, they can go buy $1,000 worth of it by getting into the secondary market for tokenized offerings. So it democratizes the ownership of these properties, which have been really limited only to the rich. So there's potential for a lot of opportunity for the average investor as well as for people who sponsor deals or who own large properties.
Does the SEC get into this about after 1 year?
Yeah, it's all in the SEC rules.
It is.
These have
Okay.
always been the SEC rules.
Okay.
Okay. After 1 year, this is what you can do. And there's some things you can do if you're an issuer, and there's some things you can only do if you're an investor. And I won't go into all the rules. I am not a securities attorney. I don't even play one on TV.
Right. Yeah. Yeah.
You can always check into that yourself. But it's my understanding that after that year, the accreditation piece is no longer required. So you can sell to an average investor. And so, but you never could. I mean, it was legal. And then a lot of times you would have sponsors set up their operating agreement so that you were not allowed to sell except to people who are already approved by the sponsor, which is still something you can do with a tokenization. You can still manage it that way if you prefer to. But if you do want to be able to sell to a broader market, not only do you have the legal authority and you can have the permission of the syndicator, but you can actually have the practical ability to do it because it's relatively easy to set up a marketplace to trade crypto tokens. You still have to follow SEC rules, and there's a lot of them. But
Yeah.
there's more than one way to do it, and I think that we'll see those marketplaces really coming to fruition. They're not there today. They kind of exist, and you'll go to a secondary marketplace and you'll see, 5 offerings on there. And so someone will go there and they'll see 5 offerings. They'll come back in a month. They'll be the same 5 offerings. So they don't even come back anymore. You need to start really building that into a real marketplace. And you need to be able to provide real liquidity. And those are some of the things that we're trying to do with our company Grotto that no one else is doing. We think we know how to actually bring that liquidity into the market so that people can have confidence that if they do want to be able to sell, they have the ability to sell.
So what would you say the difference is between some of the crowdfunding and fractional share type places versus this tokenizing?
So, well, part of the crowdfunding is really charitable, right? It's
Okay.
not really a fractional ownership. And so a lot of the GoFundMe and things like that, you don't get ownership in something because it's a security. I mean, if you're having fractional ownership, you're passing the Howey test. You have an investment of money in a common enterprise with an expectation of profit due to somebody else's efforts. So you have to follow the securities laws. Now, there's a lot of places out there that do allow you. I mean, Fundrise, I think, was one of the big ones. There's a few of them out there that do bring securities offerings online, and they make it easier for accredited investors to come in and find more offerings and invest. And those are really good. And I will bet that every single one of those will be on the blockchain within 3 to 5 years as well, just because it's easier to manage, it's easier to get compliant, and if you do accreditation with the platform instead of just the offering, and you're actually an accredited investor and you follow all the rules, they may be able to allow you to invest in all the offerings in the platform, to vet you for all of them, instead of having to vet yourself every single time you go to every single offering. So there is an advantage there. And so it would not surprise me if all of those groups also put those offerings on blockchain.
Like what you were saying too, if you've got two apartments otherwise identical, you're always going to take the one that's giving you more liquidity choices.
More
And
liquidity, more optionality.
yeah.
Now, there's I don't try to advertise this, right? But whenever you add liquidity to a market, something important happens, and that's that the price goes up. So it may be possible that the price of the apartment complex that has liquidity would
Hmm.
be more than the price of the apartment complex that doesn't have liquidity just because you have the liquidity. Liquidity is a value that adds to the value of the actual property itself. I've heard people estimate things as anywhere from 10 or 20% premium to double. But we're trying not to advertise that because I really like the idea of it being worth what the property's worth. And that should be a floor. I mean, you should be, as long as the property is worth $1 million, your tokens altogether should be worth $1 million because you can just hold on to them and sell the property. So,
Interesting. Yeah.
but
Yeah.
but there
Yeah.
is, but every time you add liquidity to any market, you almost always get price increases because there's more money chasing the same return.
Right. Yeah. Yeah. It's a new way to make money. And do you think it would be the same return? I guess there's no reason for it to go down,
Well, the sponsor's providing you the return,
right?
right? Because they're providing you the cash flow, they're providing you the depreciation, which still flows through in a tokenization, just like it does with a syndication.
That's an important point to
Yep.
say again. You still get depreciation.
Yeah. You still get the principal pay down, right? Um, you still have the real estate leverage, right? Because the sponsor is going to probably leverage the real estate, so they're only raising part of the equity value. But you just get the optionality.
Yeah.
But the other case here, and this is a very interesting case. Suppose you already own a property. Let's say that you own a nice office building and you've had it, it's been in your family for 30 years. And you want to do some estate planning because you've got 6 kids who can't get along and couldn't agree on what to have for dinner, much less on what to do with the property. Well, what if you tokenize that property and you make sure that someone is managing it because you have to make sure there's someone actually taking care of the property. But now you can distribute the tokens to your heirs proportionally to however you want to do it. And they can buy or sell their tokens as they wish. They don't have to agree now. So estate planning, partnership dissolutions, divorces, there's all kinds of things that can be done with your equity if you fractionalize it. So you don't have to even be doing a raise to raise your money. You can tokenize your property now. Think about it this way. If you own a company, if you own a public company, okay, and you want to raise money, you can issue more shares. And if you're flush with cash, you might buy back shares and make the rest of the shares more valuable. Okay. Well, if you have a small business or if you have a real estate project, now you can do kind of the same thing. You can tokenize the whole thing, and now you have this fractional equity. And after you're through your lockup period, you have the ability, instead of saying going and getting a loan when loans are at 7%, you can sell off part of your equity to raise money, buy it back when you have more money. And so you have another way of managing cash flow and equity that you didn't have before. And only because you've tokenized as opposed to just kept it as a single ownership.
So you would sell your shares or tokens, whatever, with probably a buyback option in the contract
Yep.
so that when they went to liquidate, they would have to come to you first. And then, yeah, you could make a determination. Is it easy to add contracts to tokens? Is it easy
So,
to,
so, um, so then the history of cryptocurrency, right? And in the beginning, there was Bitcoin,
yeah.
and Bitcoin was a way of trading value. And the next big advance was Ethereum, and Ethereum was really a virtual machine. So Ethereum was a way of putting contracts underneath tokens so that you could execute almost anything that you wanted as software. And so they're called smart contracts. and they can have automated execution and automated restrictions that are underneath there. So all the security token offerings to do a tokenized offering like this are essentially smart contracts. There's a smart contract that underlies the tokens. And it's those contracts that say, okay, you can only buy it if you have been through KYC, know your customer, anti-money laundering checks, and if you're accredited. Okay, so at the beginning, that goes through there. Well, and then maybe you have to be, I think it's called a qualified investor if you're in Europe, and you have whatever the restriction is in South Korea, and whatever the restriction is whatever. It geofences you, and it puts those restrictions on who can buy. And then once you've bought it, it says, this token was sold at this point. And so there's a lockup period. And so it can actually have the timer of a year that keep you from selling that token automatically. You just can't do it until the year's up. So all these things are actually software that underlies the token. And that is exactly the way that many blockchains are set up now that you can do underlying software underneath tokens.
So that's key. That's really key. So for instance, when you have a syndicator that's going great guns and doing distributions, but suddenly the interest rates or something happens and they have to pause distributions, would they have likely put in the contract? It's probably the PPM, that's the contract for the token. And that's a provision that says, should the general partners need to pause distributions, then it would be, I guess, right?
So typically, the way the smart contracts work is whenever the sponsor decides to make a distribution, and that's usually completely in their control, then what they have to do is they make a single distribution, and it gets divided among all the owners according to the correct waterfall. Because some of these syndications have pretty complicated waterfalls.
Yeah, yeah.
And those calculations are done automatically by software. And so the syndicator only has to say, okay, this quarter, maybe they do quarterly, maybe they do monthly, maybe they do yearly. Typically, the contract doesn't require them to distribute any particular time. It's just whenever they distribute, it divides it correctly. And so that's still completely under the control of the sponsor.
Yeah. And so then just to talk it through a little bit more too, take the example of somebody that's got the building that's been in the family forever. Maybe the person that's going to bring the tokenization option to the family, most likely they are probably the one that's managing or most involved in management. I am envisioning you would talk to your heirs, siblings, whoever, and say, look, we can do this, but someone's got to be the responsible party overseeing it.
Yeah.
I'm willing to do that, but you got to let me manage.
Yeah.
And you're not going to have a vote, probably, or you only have a vote. You got to control it somehow, or else you're like, you don't want them selling to every Joe, Dick, and Harry, right?
Yeah. So it works exactly the same as any sort of syndication or joint ownership could work. So let's suppose that you wanted to let the heirs vote on some major decisions. Well, you actually can do the voting on the blockchain. You can put the voting in there so that when one of these decisions comes up, it goes out and the heirs will vote on the blockchain and it gets recorded there. So you can do that. I think in that particular situation, you're probably better off having some sort of either trustee or manager designated as a manager and paid as a manager, depending on the kind of property.
Yeah.
And then they're running the property so that you don't have to worry about the heirs handling it, and the heirs have effectively passive ownership. And for that matter, that manager could keep managing even if all the heirs sold.
Right.
They could all sell their passive interest to other people, and the manager could keep managing. And you could say have a voting regimen where the heirs could change managers if they wanted to. So they could get together and vote to change managers. So all that stuff can be done, which is exactly how you might structure it, even if you weren't doing a tokenization.
Right. Yeah.
It's just with the tokenization, you make it so that it's easier for one heir to just sell their position or leverage their position, or give away their position if they want to. So you no longer have to require everybody to agree, say, to sell the property, which is what often happens now.
Right. Yeah, that's terrific. It is. I think you're right. It's coming quickly. How many people are creating platforms to help do the tokenization of real estate?
So actually, there are quite a few out there. Almost every day, I turn around and find another one, but very few of them have much traction. And the reason I think that's the case is that most of them do one piece of it. Some of them will be able to create security token offerings, but they don't do custody. They don't do the securities documents. Um, they don't do the KYC AML. They don't do the secondary marketplace. They don't do all the other things you need to make a secondary marketplace actually work. And so there's a bunch of companies out there, and some of them have done some really great software, and they have some really good products that are out there to do this. And our approach as Grotto is to find the best of those companies and to find some company in every piece of this process that we need to make it all work, and then to integrate that together. And if anything, that's my superpower, is understanding that algorithm to get from, okay, I want to do this, and here I want to get the liquidity. What all has to happen in between? What's that process? Vetting the companies in between, and then finding the interfaces to get those companies to talk to each other. That's what I do really well. And so that's kind of why I've stepped in to do Grotto. But some of the larger companies that are out there, if you're more institutionally minded, there's a security token offering company called Zonix, Zoniqx. They're
Hmm.
trying to get all the odd letters in there. And then there are companies. T0 is a good secondary market, and they also do some tokenization. Securitize is one of the longest lasting ones, but they focus more on private equity, companies that want to issue effectively stock on the blockchain as opposed to real estate. Um, there are companies, Evergon, which is out there we're talking with. And I actually have a friend who I worked with to help start his company. It's called RE Tokens. Great guy. And they've done a nice job of having both a primary and secondary marketplace and getting themselves licensed with broker license and what they call an alternative trading system license that allows them to sell tokens in a registered and legalized way. So they're very strong too. We're finding there's a company called Proppy that does single ownership on the blockchain instead of fractional ownership.
Oh,
And then they've also developed a title company that'll do real estate closings in like minutes instead of weeks. They're very, very strong. They're actually based in Miami, which is not too far away either. They're a very good company. They've just got $100 million to come in and buy title companies across the US and bring them into their automated AI-based closing process. Very cool. Uh, so there's like I said, there's a lot of really good companies out there that are doing some fabulous stuff, and our goal is to collaborate with them and bring them into this ecosystem and fill in the gaps where nobody's really doing a piece that has to be done to make it work.
so I like to try to understand how people approach things. And you're a true integrator if you're looking for who's already accomplished a great deal
Yeah.
instead of you wanting to start from square one and learn from them, but build it your way. I think it's way better being the integrator myself.
Well, it's faster and easier too,
Yeah.
right? If they do a good product, the only real key you have to be able to do is to find at what point does that have to communicate with this other product, and what do they have to be able to say to each other? And then you design that interface.
Yeah.
And I mean, once you design that interface, they can probably implement it in days. So now you're talking much, much simpler development. And you have companies that are already developing, already have teams of developers, already doing great stuff. And I would love to see everybody win on this because so tokenization of real world assets in 2023 was about $2 billion total on chain.
Okay.
Today, it's about $20 billion. which is the 10x. And the projections are closer to $20 trillion by 2030, another 4 years, 1,000x over today. So you draw that curve, it goes straight up.
So how can we all be a part of that?
Well, there's a couple of different ways. One is if you are a syndicator or if you have a fairly valuable property, probably 5 million or above, you can tokenize it. So you can tokenize it. You can come to us. We'll help you with that. If you're doing a syndication, you can do it as a tokenization instead of a standard syndication. It's a little bit more upfront cost, but I think you'll save that over time. And I think you'll be able to attract more investors, which also saves you time and effort.
Right.
That's one way. If you're an investor, look for tokenized offerings. Some of the companies I just mentioned have platforms where you can go find existing tokenized offerings and go take a look at those. Or when you're trying to invest in a syndication, ask them, why aren't they tokenizing? They should be doing that so they can give you liquidity. And I think once the sponsors hear that from a few investors, they will start looking into it more
They'll
often.
start looking at it. Yeah.
Now, if you're not an accredited investor and you would like to own a beautiful apartment complex, even if it's only a small piece of it, keep on the lookout for us and for others out there who have secondary marketplaces. Again, I can point you to T0 or retokens.com, and I'll be able to point you to Grotto. We're still in launch phase, so we don't have our platform up yet. But in the next 60 to 90 days, we do expect to have that up and going.
Are you raising capital to build it?
We are raising capital to build it. We have a small, what we call safe round, a simple agreement for future equity of about $500,000. And then we will plan to follow that with a seed round of 5 million.
Okay.
This is not an offer of a security.
It is not. Yes, right.
Just to be really clear.
Yeah, I'm just
And
talking.
to be clear, right? We intend to tokenize our offering. So we're going to eat our own cooking. So what you will get is I've been calling it, instead of a safe round, a safety round. Simple agreement for future equity in tokens, future equity tokens. So safety. Anyway, I don't think that's a term yet, but but we'll create it. So yeah, we are looking for investors there, and we'd be happy to talk with people and tell them about our company. And if there's interest, we could make an offer.
Great,
Um,
great.
and the other way I will say, and this is probably for future, if you would like to help provide liquidity to a real estate market like this, so you're willing to be invested in a bunch of different real estate products, and you would like to make money off of you're buying the tokens a little bit less than market and selling at market, there's an opportunity for liquidity providers to come in and invest in the secondary market. And so you put your money in, and then you make money off the churn, essentially. But you're providing a valuable service because
Right.
that means that someone who has a token who wants to sell, they have a buyer, and that's you. And then you can sell on to others. And so it actually makes the market, it makes the whole thing, it greases the whole thing and makes it all work. So that's another kind of investor that we'll be looking for as well.
Does any of this cross into stable coins at all?
So stable coins are technically a form of real world asset tokenization. Because to do a stable coin, especially with the Genius Act that came out last fall, you are supposed to have backing, audited backing of your tokens. So most of the people who are doing stable coins, most of them are based on US dollars, right? So USDT,
Right.
USDC, all these things.
Yep.
They hold US treasuries, not actual cash, but US treasuries in an account. And that's an auditable account, and they can only issue enough coins that they could redeem the coins by selling the treasuries and redeeming the coins. So that's how it's supposed to work. They use treasuries because at least they get some yield, and so they can kind of continue to increase their stake while the coins are out there. So technically, stable coins are a kind of real world asset tokenization. They're tokenized dollars or tokenized euros. So yeah, this does actually apply to stable coins as well.
Gotcha. Okay. Okay. The only thing about, from what I recall, and hopefully I'm not taking it on a tangent, is that if you take money out of a bank to buy stable coins, then you're investing in our debt through the treasuries, but you no longer have the insurance on your account that you had while you were in the bank, right?
Well, that's true. You do not have FDIC insurance right now owning stablecoins. I say that's right now. Um, I think uh, I'll have to check this to be sure. I think if the Clarity Act gets passed, that you might be able to hold your stablecoins in your bank account, and those would also be under FDIC insurance as well.
Ah, interesting. Okay.
So don't hold me to that for sure.
Okay.
I think that's part of the Clarity Act, though.
Okay. All right. So let me have you restate what the takeaway is before we go into the final questions here.
So if you're a syndicator now, in 3 to 5 years, you will be doing your syndication as a tokenized offering. It's just a better accounting system at its core than what you're doing now. And if you can also provide your investors liquidity, that just makes it so much easier to bring in investors. So if someone else is doing a similar offering and they're offering this to investors and you're not, they're going to choose the other offering.
So, and if they wanted to have a pre-qualification in there still, or first option to purchase or anything like that, all of that
They
can still
absolutely
be.
can do that. It essentially comes down to what they call managing a whitelist. So you're managing the approvals to buy your tokens. And that management can be lightweight, it can be automated, or you could actually review and say, okay, I only want these people in, and I don't want these other people in. Going to be careful about that, but because if it's a public, if it ends up being offered on a public exchange, then you have to be careful how you limit things. But you certainly can do certain limitations and controls, and you can maintain the existing controls you have. You just won't be providing necessarily as much liquidity. I mean, you can be in there and you can say, okay, well, I'm going to see who's going to buy it, but I'll let somebody buy it as long as I approve of them. So you can have any kind of range of control in there that you want.
Right. That's the thing about this. You can write a contract to be anything you write it to be. It's
Yeah.
just, you got to be compliant with so many different laws out there, but there's
And just so you know, we test all this in what we call a sandbox
right.
before it ever goes live. We make sure all the software is worked. And this is really simple software. This is not complicated
Okay.
AI generated software or anything that's like thousands or millions of lines of code. This is like, tens of lines of code to do this sort of thing. So this is actually fairly simple to figure out.
So since we're kind of on that topic, and I know it's kind of taking a turn a little bit, it's a topic that's very interesting to myself and many people I know. And you touched on it early on when you were talking about the communities where people that want to or that work in the community should be able to afford to live in the community.
Yeah.
And in my mind, I'm thinking that can all be contractual, where you are setting aside property, right? Where they have certain income. It's based on income or whatever, right? Is that how you envision doing it so that people can afford to
Well,
live there?
we were thinking of creating a new kind of ownership. Think of it as a layer of ownership on top of standard ownership, which is this. I mean, all this fractional tokens, these are kind of a layer of ownership on top of what you already have recorded on the title and the deed. Um, and we're combining equity and rent and property management. And so we would have the person be hired as the property manager for the property. Because remember, we were talking earlier, somebody has to manage that property and be
Yeah.
accountable for it.
Yeah.
And so then they would put down whatever they can. And in some cases, that might be a down payment. And in other cases, it might be more like a security deposit. But that money goes to purchase equity. So they have equity in tokens and it's fractional. They can be as small pieces as you want. So every time they make a monthly payment, one portion of that goes to buy more equity, And the rest of that portion goes to pay a return to the person who has all the rest of the equity, to the capital provider who has all the rest of the equity. So they're getting a return on their money. And then they have an obligation as a property manager to maintain the property. So as long as they're responsible, they're maintaining the property, they're making their payments, then this all works really, really well. Now, suppose they can't make the payments anymore. Now you have more of an issue, right? But they don't lose their equity, which is what you would do if you owned a house, right? If you can't pay the bank, they'll foreclose on you. They'll go sell it for a song at a foreclosure sale. You lose all your equity. Instead, they might be fired as a property manager if they're no longer maintaining the house. They might have to leave, or they might want to leave or move somewhere else. They have to be
Mhm.
paid for their equity because they built this up over time. And then they'll be that capital provider probably is a purchaser of first resort for that equity. So there's some ways to make this work. It is challenging in some ways. Part of the keys is accountability. And so if you have people being accountable to managing the property, then you can work through a lot of other things. And then you can work on payments to make sure that those payments fit. And there may be ways of trading equity for payment to come in and out of ownership a little bit if there's a few months where they're challenged. And then we also think if we were doing a whole community, if we're doing a whole sustainable community, we also have ways of allowing people to earn in the community
That's
that
yeah.
would allow them to be able to make their payments for sure. So there may be additional work they could do in the community and a job or other things that can be done just to make sure that they're okay. So there's a lot of pieces and we
A
have to get it
lot of
all worked
pieces.
out, but I think it's doable. And I think it would be better than, I mean, today, if you own your house, you don't really own your house. And in a sense, you're renting it from the county because if you don't pay the county, they take it away from you. And you're renting it from the bank because if you don't pay your mortgage, they take it away from you. And so we think there are ways to get past both of those issues as well.
It's a dynamic field to be in, but somebody that can balance so many different things like you do is a good one to be building something like this. I'm glad that we got together and we were able to do this. I need to ask you at this point, like I ask everybody, um, is there a pivotal person or event that brought you to where you are today, or is pushing you towards a certain goal?
Well, there are several people who've been pivotal in my life here. Um, I got into real estate after I read Rich Dad Poor Dad with Robert Kiyosaki. And so it's almost unfair to nominate him because he's like been pivotal in almost every real estate investor I've met, right? But
Yeah.
I think you told me when we were talking the pre-brief that he hasn't been nominated. So Robert Kiyosaki definitely should be nominated as a pivotal person.
Yes.
Um, uh, a second person I would say for me is a guy named Sherman Ragland. And he runs the DC Real Estate Investment Association. And so he's given me all kinds of opportunity and to teach commercial classes there, to be an agent. He actually runs a brokerage as well. And so I'm a real estate agent with his brokerage. And I would say that he actually was the one who first put the idea in my head to write a book. And so cryptocurrency and real estate is at least partially due to him. And so I would say that he's a pivotal person. And then lastly, and unfortunately, you can't give him a pin because he's no longer with us. But the person who offered me cryptocurrency for land, a guy named Robert Steele or Bob Steele, and he is the most creative real estate deal structurer I have ever met. He has a book out called 300 Ways to Buy, Sell, or Exchange Real Estate. And I think he added 100 in the latest version. So it's like really 400 ways now. Um, he's the guy who got me into cryptocurrency. And you think of cryptocurrency as a young man's game or a young person's game. He was in his 90s when he was innovating in cryptocurrency. So very kudos to him. He was an absolutely amazing man. He did pass away. I think it was late 2024. But he was grandfather of exchanging, and he's done some amazing things. So I would say those three people are some of the most pivotal in my life. And I've been fortunate enough in the past few years, actually just in the past year, to meet Robert Kiyosaki and become friends with him. And so I'm actually helping him trade his house as opposed to sell his house, which is kind of a cool thing we're going through. And he's written a foreword for the second edition of my book, which should be coming out later this spring.
That's terrific. And tell us the name of your existing book and this book now.
So the name of the book is Cryptocurrency and Real Estate. Um, See if I can. Looks kind
Okay,
of like this.
good, good, good.
Has a puzzle house on the cover. Published in 2021. But I'll say when I was working on the revision that the original holds up really well. I mean, some of the numbers are different, and there's definitely things that have happened since then that are important in cryptocurrency. But I get into the basics, both of cryptocurrency and of real estate investing from an exchange perspective. And
Mhm.
so all of that has held up really, really well over 5 years. And the new version, I don't have a publication date yet, but I'm expecting later this spring.
Very good, very good. So would that be available on Amazon?
Yes, it is available on Amazon, and actually it's on Audible as well.
Good, good,
For
good.
those of you who don't read, but you actually want to hear the book.
I'm afraid that's me. I don't sit still
It's a
much.
lot of people, actually.
Yeah, yeah. So do you read it? Or is
Do I
it you?
read my book?
Yeah.
Um, I don't read it over and over again.
I mean on Audible.
No, I was going to. I had trouble getting all the equipment right to get the noise decibels perfect.
Yeah, yeah.
And so Kendall reached out to me and said, "We'll have an AI read your book for you if you'd like." And I said, "All right." I went in and I had to correct a bunch of pronunciations, but it did a credible job. The next one I'm going to try to read myself.
Yeah. Yeah, there's nothing like that intonation, right?
It really is, and it wasn't bad. It really wasn't bad. It's definitely able to listen to it and get what's going on. It's not a performance. And some of the people who read books are just incredible performers.
Yeah. Awesome. Well, I can't wait to read it too. Very good. Well, so tell people how they can reach you. And remember, some people are only audible. So spell out
Sure.
things. Yeah, please.
So reaching out to me, the best way is through LinkedIn. And so my name is Steve Streetman, Streetman. And if you look for me, I think I'm the only Steve Streetman. I might not be the only Steve Streetman, but if you read the bio, you'll figure out who I am. And my picture's on there. Um, to reach out by email, you can go to grottotokens@gmail.com. That's GROTTOTOKENS@gmail.com. And that should get you to me. Would love to talk to people. I love talking about all this kind of stuff. We can do real estate tokenization. We can do agile communities. We can do real estate exchange. I did do a 20-page intro to real estate exchange, which, if people reach out to me, I can get that out to them as well.
Yeah, I'd love to get that too. Yeah, yeah. And so far as the name Grotto, how did you come up with that?
So Grotto is an acronym. So it's global, real world assets, on-chain, title, tokenization, and ownership.
Very good. That will
So,
help
so
people.
just remember the G is for global.
Very good. Well, thank you so much. I really appreciate you coming on the show, and we are definitely going to stay in touch. And we'll put all that information in the show notes, and we'll
I
have
really appreciate it, Jenny. Thank you for the opportunity. Look forward to collaborating with you on other things too.
likewise, likewise. Thank you so much.